Let's see. Have you been with Brooks and Davis for a while?
Yes,
Okay.
definitely with
All right,
Brooks
cool.
and
Then yeah,
Davis.
we've ran into each
Definitely
other
at
before.
networking
Yeah,
events and
100%. You
everything like
know,
that.
I try to be everywhere I can.
Yeah.
All right, let's see here. Yeah.
Recording in progress.
Okay. All right. So open up this. All right. Cool. All right, cool. So we're just going to go through some mortgage basics today. I think it's always good just to remind yourself of the mortgage process. Of course, when it comes to getting someone pre-qualified or mortgage questions, if you don't know it, I always say don't try and answer it, right? The worst thing you could do is tell your client the wrong answer or lead them into the wrong answer to where when they get to me, I'm telling them the right answer and they're like, well, my realtor told me this.
Mhm.
So this is just a good baseline knowledge of just to kind of get yourself comfortable if somebody has some questions or anything like that, that you know exactly, how to answer or where to direct those questions to. So again, my name's Mason. I'm with Union Home Mortgage. If you did not know, I Union Home Mortgage or NRL Mortgage is where I was before. We recently in February merged with Union Home Mortgage, so still all the NRL people, still the same feel, still the same service and rates that we've been provided before. So if you worked with me before, really nothing has changed besides the name change, and really we're just getting quicker and faster. So for me, just a quick about me, just so you can kind of understand who I am. I live in Richmond with my wife, daughter, and we're expecting another daughter in February that we're super excited about. Thank you. And then four furry kids. I'm a huge animal person, love dogs, love cats, love all the animals. Graduated from LSU, so go Tigers. LSU runs my life. Football season's coming up. I'm already stressing about the first game. If we lose that first game, I'll be depressed for about a couple months. I let the football games really drive my happiness. So I got in the mortgage business in 2018 when I graduated from school, and I got licensed in 2020. So when I became a loan officer in 2020, I was instantly the number one loan officer within the company in my first year. So I was rookie of the year. And really the reason for that is because before I became a loan officer, I was in our corporate side. So I was able to learn about how to send disclosures down, really nail down guidelines, learn how to lock loans, learn how to sell the loans, really all the ins and outs of the mortgage process, and then just really learn from my bosses and just be a sponge. So having that knowledge before I became a loan officer is really different. I would say 95% of loan officers just go and get their license and learn as they go. I was able to learn, get started, get my baseline, and then become a loan officer, which really helped me just take off. So in the last 5 years, I've closed over 275 loans and over 85 million in volume. I think if I looked at that number today, I might be close to 100 mil, so very close to that. But I share that just to show you that I'm an expert at what I do. I get people to the closing table in a timely and smooth manner. The worst thing that a loan officer can do is approve your buyer and not get them to the closing table, right? So I do everything up front. And then I bought my first home in 2020. I have a 2.25 interest rate on that house, now renting it out. And now I bought a new home at the beginning of this year and I have a 6.875. So I like to tell my clients that just so I can connect with them. So when they're crying or being upset about the rate that we're providing, I can say, hey, look at me, I'm the lender, and I also have a 6.875. So rates are what they are. It's all about when you're ready to buy. And then if you haven't followed me on social media, Mortgages by Mason, please follow me on that just so I can stay top of mind to you. And so if I post something, you'll be like, oh my gosh, Mason, that's right. I need to send him a deal. My service. Okay, so recently I have hired my own processor. Before she was my corporate processor, and she's been with me about 4.5 years, almost 5 years. But I have taken her off the corporate side, and where she's only going to be my assistant. So I'm super, super excited about that because I've been blessed with a lot of great realtors and referral partners where we've just really taken off, and where I can have her on my side to making sure we're getting docs on time, making sure loans are getting through in a smoothly and time manner. So besides me, if I don't know your answer, I know somebody who will know that answer. So my team is full of masterminds. I have my processor, my underwriter, meaning I'm not sending the loan to a different company and waiting for them to respond. I have full control over the process. I like that because if something goes wrong, I can jump in right then and there. I don't have to go through multiple hoops. I can get the job done. And then again, with my underwriter, being friends with your underwriter, I mean, it goes a long way. So if your underwriter is in a file and they see something that may not look right or maybe something that she doesn't like, she's going to call me and she's going to, tell me ways to resolve that issue rather than like, sorry, you're screwed. I already saw it. Right. So having my process and my underwriter really changes the game. And then besides my rates, my service is unbeatable. Okay. So of course, every lender that you go to say, hey, I had the rates. I had the rates. I don't lose loans because of rates. So our rates are very, very competitive. And then, of course, my service is unbeatable. So phone calls on the weekends, phone calls on after hours, holidays. I'm going to be the one to answer those phone calls for you and help get your buyers pre-qualified in those times where some lenders just won't answer the phone. I'm your lender for life. I just turned 30, so I always say that I'm a workaholic. I don't expect to the guy visitor behind you. I don't expect to retire anytime soon. I always joke, unless I win the lottery, then I'm moving to Thailand. You'll never ever see me ever again. But if I don't win the lottery, I'm going to be a loan officer for your life. So for your first purchase, second purchase, all your refinances, I'm there for. I'm truly a workaholic. I think it's just kind of passed down in my family. Everyone in my family is a workaholic. We love to work and get stuff done. So I'm your lender for life. I always joke because my communication is top tier. If you do not get a response from me within 24 hours, please call the police, please call the hospital, please call the missing people. I could be missing, something could have happened to me. So I really pride myself on getting back to you in a super fast and a timely manner because again, this is when people are going through one of the most stressful times of their life, right? Buying a home. So they're having tough sleeping because they just want an answer on a question that they have. It could be such a simple question. So I'm big on getting back to my people as quickly as possible. And then again, just like this, I'm big on mortgage education. In high school, they didn't teach us so much on how to buy a home, right? So I was big on, okay, well, I now know how to buy a home. My friends are looking to buy a home. I want to teach them. I want to teach everyone how to buy a home. It's not as hard as that some people make it to seem. As long as you have a good realtor and a loan officer, you can get it done. So some things we're going to cover today, some start to finish. We're going to go over your application or getting an application, getting pre-qualified, pre-approved, some types of employment, main factors we look at when getting approved, documents we need, some type of loans, first-time buyers, disclosures, special loan programs. We'll go over the closing process, quickly touch on on the refinances, and then go through our final thoughts. So from the first time you connect me with your client, which I prefer text message, group text, throw us on a group text together. I'm going to jump on a call with your client before we get an application filled out. I'm always going to talk with your client before an application just to go through their scenario and answer any questions. Because again, a lot of times when they call me, they're all stressed out, right? They're like, oh my gosh, I'm having to get all this. So I like to talk with them and smooth them out and just ease their way into it, go through their whole scenario. So these are the 6 questions I'm going to talk with the buyer about. So I'm going to go over the time frame. How soon are they looking to make a move? What do they pay now for rent or mortgage? And most important question to me is, what do they want their mortgage payment at now? Okay, that tells me everything I need to know, right? Where to keep their purchase price. Because if they tell me, hey, I want a payment of $2,000 and they're looking at a 500K home and putting minimum down, I can tell them right then and there, your payment will 100% come over that. Credit score, I want to know what their credit scores are. Are they W-2? Are they self-employed? Is it a new job? Are they relocating? And then, of course, assets. What do they have saved up in the bank today? What are they looking to put down? Every time I talk to your client, I'm going to be writing this down in my notes. And then I am then sending you a text message as soon as I talk to your client. So you know, 1, that we spoke, and 2, what type of client that you're working with, right? So this is just an example I sent to one of my top realtors. Hey, info on Jessica and Corey should be a good one. 100% disabled, VA loan. Again, timeline, purchase price. This I like it is a time saver, right? Because if you're like, I'm gonna go show my clients or show this client all these houses, and I send you a message saying, hey, they don't have any money, they don't have a job, or maybe their job is new, they don't have 2 years of experience. That should stop you from going to show homes, save you some money, save you some gas money, because our time in this industry is very, very valuable, right? So we want to make sure we're not driving around like crazy and only going to show homes with people that are qualified and ready to go. So once they talk with me, to get them pre-qualified, right? Every lender gets somebody pre-qualified. They're going to talk with the lender, me, submit an application. From when you get the application submitted, you're going to submit some documents. We'll get the credit pulled. We can't do a soft pull. I always recommend a hard pull. A hard pull on a credit is nothing to be scared about. So I will typically try to tell the buyer, hey, we should do a hard pull. But if they're adamant about doing a hard pull, we'll do a soft pull, but I'm huge on a hard pull because on a soft pull, you cannot go to Fannie Mae, you cannot go to FHA, Freddie Mac to see if your loan is fully approved with them, right? They want a hard pull. If all checks out, we will get a pre-qual letter sent out. But if we want to go that extra mile to make sure they're fully approved, we will get them pre-approved. That means they're going to go under my underwriter and get fully approved like they would when they go under contract. This helps us close a loan within 15 days. It helps your offers stand out. There's multiple offers. So this is just a really good way to kind of get ahead of the game. And for me specifically, my team, I make my team on any self-employed buyers, we certify the income upfront. Meaning when I get a self-employed buyer, I get your tax returns, I do an income review, and then I send it to my underwriter to certify that income. Because again, the worst thing that I could do is pre-approve your buyer, go under contract, spend money on inspection, spend money on earnest money appraisal, and then I go, oops, sorry, you're not approved. I will never be allowed in this building ever again. So I want to make sure I'm invited back and continue to do business. So that's why we do everything up front. And if I see that the scenario is a little bit shaky or like DTI is tied or your job is just kind of weird, then I'll send you to my underwriter just to make sure we are fully good to go before we get too far. All right, so types of employment, W-2. W-2 is the most common employment, right? We got, I would say maybe probably about 80% of W-2 are self-employed, but W-2 people, 2 years of experience in the same industry. Technically, you can bounce around, but if you're from industry to industry to industry, going to cause some issues. If you recently graduated from college or trade school or anything like that, high school does not count, but if you graduated from any type of trade school or college, you do not need 2 years of experience. Okay, so if you graduate from school, let's say you graduated from welding school, you get a full-time job, an offer letter stating that you're a full-time employee, you can qualify right then and there. You do not have to wait 2 years. If you switch from self-employed to W-2, you can use your self-employed history as your 2-year history. So it makes it easier to qualify there. If you make overtime, bonus, or commission, you need 2-year history of that income to use that income. Okay, so for me, I'm 100% commission. Okay, if I just became a loan officer today, I would have to wait 2 years before I can buy, right? We need to see history of the commissions that you're going to make. Job gaps. If you've been out of a job for more than 6 months, layoff, stay-at-home mom, stay-at-home dad, you need to be back at your job for 6 months for us to use that income. So, for example, this is more common for stay-at-home moms. Maybe they were working in 2020 and 2021, took a break in 2022, 2023. Now they're back working in 2024. We can use the previous 2 years in 2020 and 2021. We just need those W-2s. As long as they're back at their job for 6 months, we can use that income. All right. So if it's hourly, if they're not guaranteed 40 hours a week, big thing there. If they're not guaranteed 40 hours a week, they have to be at that job for at least a year to use that income. Okay. So meaning if they have 2 years history, they go get a new job, but it's not guaranteed 40 hours a week. They need to be at that job for at least a year to use that income because we need to see history, right? So when I'm asking buyers, hey, are you W-2 or self-employed? They'll go W-2 and say, are you hourly or salaried? They'll say, hey, I'm hourly. I'll ask what's your hourly rate. And then I'll go, are you guaranteed 40 hours a week or do you sometimes work less? They'll either go, I'm guaranteed, or hey, sometimes I work 38 hours a week. That tells me they're variable income, meaning they need to be there for at least a year to use that income. All right. Moving to our docs for W-2, driver's license, last 30 days of pay stubs, last 2 months of bank statements, and your 2024-2023 W-2. Pretty easy there. For our self-employed people, so that's anybody that's all our realtors, right? Y'all are all self-employed technically, and you must have 2 years of taxes. Okay, if you don't have 2 years of taxes, it is very hard to get you approved. Sometimes we can use 1 year of taxes. That's if you've been in business for more than 5 years under conventional or Fannie Mae, Freddie Mac. Which is great because again, we don't have to use a 2 year average. But if let's just say you're a construction worker, all right, you're a W-2. Then you start your own business or you become 1099. You have previous history of being a construction worker. So if you start your own business and that first year of taxes are really, really good, then yes, we can fight with underwriting to use that 1 year of taxes as income. But again, your first year of self-employed needs to look good for us to use it. All right. If you switch from W-2 to 1099, like I just said, your clock starts over unless it's the same exact industry. Okay. So for most people, your clock starts over. Got to have 2 years of taxes. All right, so for our self-employed people, 1099, you need your driver's license, last 2 years of tax returns, and last 2 months of bank statements, and then we need a year-and-date profit loss statement. Does not need to be from your CPA. I can help you fill that P&L statement out. So 3 main items we look at when approving a buyer. All right, so credit. That's going to be one of the main things we look at. That's going to be the first thing that I look at is pull your credit, right? We're going to pull your TransUnion, Equifax, and Experian. Your middle score is the score that we go with. If there's multiple people on the loan, we have to go with the lower middle score between the two of them, okay? A lot of times I'll ask, hey, what's your credit score? When's the last time you've seen it? They'll go, Credit Karma is showing that I'm at 600 or I'm at 640. And I'll go, I'm gonna just knock this off. And I'll go, okay, great. I know you're seeing 640 on Credit Karma, but that doesn't mean that's what we'll see when we pull credit on our side. The reason for that, every industry is on a different credit system. So bank apps, auto loans, credit cards, all of them different credit systems. So if they all pulled credit the same day, we likely see different scores. So again, gives me a good idea, but doesn't tell me exactly what that score will be. When we pull credit, your credit is good with us for 120 days, so that's 4 months. All right. Minimum credit scores for conventional 620 credit score. Fannie Mae does allow us to average if one buyer is under 640. So if we have to go conventional for whatever reason, we can average out credit scores. Typically for conventional loan, we'll put somebody who's 720 or higher. If you're around that 700 to 720, you're kind of in that gray area. We'll compare both payments. Whoever's giving us the lower payment, that's the one that we'll likely go with. For FHA loan, we allow a credit score all the way down to a 500 credit score, but you're going to need 10% down. Okay, anything between 500, 579, you'll need 10% down. If you're 580 or plus, that's 3.5% down. Not every lender allows this. Some lenders say, hey, we go down to 600, that's the max, or that's the minimum. We go down to 580, we go down to 620, we go all the way down to 500. Now, the chance of someone having a 500 credit score and 10% down,
Right.
unlikely. I've had it one time. But hey, there's an option out there for them just in case. VA can go all the way down to 500 credit score. Same thing for USDA. All right. Next thing, debt to income ratio, which we're seeing really, really bad nowadays. That's probably one of the most common problems we're seeing is just crazy debt on some people, right? So to calculate your debt, okay, so if your monthly salary is $6,000 and you have 10 or 2K in monthly debts, that's a 30% debt to income ratio. I have a slide here in a second. I'm going to show you how to exactly break down your debt to income ratio, which I think is important to know, because this is a calculation anybody can do with any of their clients and yourself, so you can see what type of mortgage payment you can afford. Your DTI includes all debts, including the new mortgage payment. Student loans still count, right? Even if you're not making payments on them today, we have to calculate a payment on that one. But your groceries, your gas, your utilities, your phone bill, that is not a part of your debt to income ratio. That is a part of your residual income when it comes to a VA loan, which is a whole nother class. That's a whole nother class to teach, but those are not on your credit report, okay? On a conventional loan, we can't go above 50% debt to income ratio. FHA, we can't go above 56% back end. Back end is all your debts. The front end ratio on the DTI, that's just your housing, right? That's your housing debts versus your income. VA can go above 60% or hover around 60%. VA really matters on the residual income. Okay, I just got somebody approved on a VA or closed on a VA loan, 67% debt to income ratio. Okay, but the residual income was so low. The VA still approved them, got them closed. That's the highest DTI I've had on a VA loan by far. USDA, a little bit stricter on them, 45%. Chance of you running to a USDA loan here in Houston, getting slimmer and slimmer and slimmer. Canberra should, again, yes, we can get you up to a 50% debt to income ratio. That does not mean that's comfortable for that person. So I will tell the client, hey, you're approved up to this payment, but you need to tell me what's comfortable to you. Because again, I can see your financial scenario, but again, we're not taking in your phone and other stuff, so you know what your budget is better than I do.
Right.
Okay, so I always ask, hey, what's a comfortable level to you? Because if you're anything like me, Amazon will be at your door every damn day. And full Amazon addiction is real bad. All right, debt to income ratio. So this is how you calculate your payment. I think this is super important to know. Okay, so we're gonna do a quick calculation together. I'm gonna break out my phone for this. So again, for conventional loan, we can't go above 50%. For FHA, we can't go above 56%. For VA, again, it's depending on the residual income, but kind of hovers around that 60%. But let's go with FHA. Okay, so we're gonna run with a $7,000 monthly salary. Okay, so if, the max debt to income ratio on an FHA loan is 56%. We're going to take that $7,000 and we're going to multiply it by 56%. We get to $3,920. So that means that's the max monthly debts they can go up to, including a mortgage. Okay, everybody has debts, right? We got credit cards, student loans, blah blah blah. So we're just going to assume this person has about $500 in monthly debts. So you're going to subtract that from that 3,920, and that would get you to a max mortgage payment of 3,420. That tells me today, with a minimum down payment, you need to stay around that 350 to 375. Principal, interest, taxes, and insurance. What we're seeing today is your payment is about 1% of that loan amount. That's just what we're seeing today. Home insurance is getting crazy expensive. Property taxes here in Houston, Texas, on the higher side compared to other cities. And then, of course, rates. Rates are doing a damage as well. So that's just what we're seeing. Now, when it comes to your payment, what's in your payment? Principal, interest, taxes, and insurance. Just to quickly break that down, principal is what's owed. Interest is how the bank makes their money. Your escrow is your taxes and insurance, which is optional on a conventional loan if you put more than 20% down. Then you have mortgage insurance. If you put 20% down on a conventional loan, you do not have mortgage insurance. VA does not have mortgage insurance, but FHA does have mortgage insurance on it for the life of the loan. Unless you put 10% down on an FHA loan, then it's on there for 11 years. The chance of somebody putting 10% down on an FHA loan, unlikely. Most of those people go conventional. HOAs, we're going to tell you what your HOA fee is, but again, it's not within your mortgage payment. Okay, so we want to make sure people know that, especially on condos and apartments, that is a monthly fee or a yearly fee that you need to pay separate. All right, but your HOA is definitely a part of your debt to income ratio. That's why on condos and apartments, sometimes people are like, oh, I'll just go get a condo and apartment for $150. That does not make it easier to get qualified, right? Because they have an additional HOA payment, which is sometimes crazy. Assets, all right? So must be liquid, checking, savings, 401k, stocks. We can't accept crypto yet. I'll take your Bitcoin. You can send it to me, but the banks won't accept it. You have to liquidate it before you can use it, okay? Down payment requirements, conventional, first-time buyer, 3%. If you're not a first-time buyer on conventional, it's 5%. For FHA, it's 3.5. Again, if you're under 580, that 10% down. VA, USDA, no matter what, as long as you have above a 500 credit score, still 0% down. closing cost. Every lender is a little bit different on this. Some say, hey, it's going to be 3% of your sales price or 1%, whatever. I'm a little bit different. Closing up, most of the closing costs do not change per your loan amount, per your sales price. There's only like a couple handful of items that change, right? Your lender's title insurance, your daily interest fee, but most of the fees are fairly set. Like our fee, 1780 to do a loan with us, always set. Appraisal fee, unless it's a jumbo loan, going to be around $600. So most of the fees stay the same. What can raise it up and down is your escrow, right? The more your home insurance are, the more your your property taxes are, the higher we have to collect for that escrow account. So excluding escrow, a good amount to save for closing costs is around 8 to 12K. Okay. If you're on the higher side purchase price, assume more closer to that 12. And if you're on the lower side, assume closer to that 8. But again, escrow is what can bring that number over 12 or under. Okay. Because again, if we're using an escrow account, we have to collect for more money. But the escrow is your money. It's the client's money. They're just putting it aside basically. So I would tell them, yes, it's technically closing costs, but officially that's your money, right? They're just holding your money for you. All right. So for our non-permanent and permanent resident aliens, for those documents that we'll need either a visa, a green card, an EAD, or a driver's license. But don't forget about these people. We can absolutely still help them. Obviously, right now, if you've seen the news, non-permanent people cannot go FHA at the current moment due to the term that we're in. Hopefully that will change because, unfair to some people. But as of right now, non-permanent people cannot go FHA. We have to go conventional. All right, so let's break it down a little bit deeper. Conventional, again, first-time home buyer, 3% down. If you're not, it's 5% down. Conventional is usually better for people who have higher credits and a bigger down payment. You have PMI if you don't put 20% down. Again, the PMI can be removed on a refinance or if you get an appraisal showing that the value has increased. The appraisal on conventional is definitely much easier. So if we're looking at a property that maybe a little bit run down, has some issues with the house, conventional is going to be the way to go. The max loan limit here for conventional loan is 806,500. So if the loan amount is above that, that would be considered a jumbo loan, right? We can get appraisal waivers on conventional on a purchase. Typically, that's going to be for anybody who puts more than 20% down. And then on a refinance, a no cash out, we were able to often get those appraisal waivers where we don't have to get an appraisal. As long as Fannie Mae, Freddie Mac have enough details, enough data on that house, we can get the appraisal waived. Moving to FHA. So FHA is 3.5% down. Again, with the 580 plus FICO score, you'll typically start to see better rates for anybody above 620 for FHA. 680 is about prime for FHA. Interest rates typically will always be lower than conventional. You do have mortgage insurance for the life of the loan unless you put more than 10% down. DTI, again, on FHA can go up to 56% back in, and the max loan limit in the Houston area for FHA is 524, 225. Appraisals on FHA a lot stricter on health and safety issues. So if we see cracks in the windows, cracks in the walls, a little bit more rundown, no hand railings, pools in bad shape, this is where the appraisal will not pass on FHA. We want to be careful on that one. So typically, I always ask my clients, send me the property before we go under contract. I am, again, that first line of defense for you because, again, that's 2 to 3 weeks wasted. If we go get an appraisal and they say, oops, sorry, we can't pass this appraisal. I could look at the property on my phone and tell you right then and there if this home can pass, unless it's just not showing all the photos, and that's where I rely on you, the realtor, to let me know that. Recently, a couple months ago, pretty upset or disappointed, I'll say, with the realtor. Hey, how's the house shape? Great, 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 great. House is great. Good for FHA? Great, no problem. Okay, great. Photos online look fine. Well, get the appraisal. There's a huge hole in the roof in the closet. I mean, huge hole. then of course we can't pass.
You said huge.
Yeah, I mean, like, it's like, I mean, two of these.
Wow.
It was huge. And of course, I'm seeing it in the appraisal photos. I'm like,
Did they not see that?
she saw it. She just didn't think it was going to be a big deal. I was like, I said holes. So I said holes. If you see holes in the walls, holes in the, if you see some holes there too, you might want to get them out. But yes, if you see some problems with the house, let me know because we want to resolve that first before we get too far.
Oh, where was the yeah, thank you. Where was the inspector?
It was not, so we don't require the home inspection report. The
Okay.
home inspection report is typically not sent to us unless we ask for it. So I didn't see the home inspection report.
All right, so was the house on the list,
It was-
listed by another realtor, right?
Correct.
So
Not the
where
photos.
was,
Because it was the primary closet. So they just left the primary closet out the photos. And they had, usually I can tell if like, okay, they have 5 photos in this. So you're missing about 25
But
photos.
the realtor should have still should have.
1,000%. But if I see a house that has like 30 photos
right,
and not all of them look great,
right.
I'm going to typically assume
Dude,
that's in good shape, right? That's in good shape. So then, but I rely on the real, because you're the ones going to look
No,
at
no,
the house.
no, I got you. I got
Yeah.
you.
So I'm like, you got to let me
So
know
it's a
that
double whammy on both realtors.
for sure. One,
On the.
On the seller and the buyer.
Okay,
seller, yeah.
The seller-
Seller is not showing it on the
Yeah.
photo, on the photos.
So this thing is, you're not showing every nook and cranny of
Correct.
of a house you're selling.
I-
But the buyer's agent is supposed to look at everything.
I put way more blame on the buyer than the selling
Yeah.
agent. I can understand it's not, I would
Yeah.
say, I would see most listing agents not put that on the photo because
Yeah.
that scares people off. Hey,
Yeah.
just come and see it. Just get them in the house.
Right.
I don't like that as much,
Right.
but my buyer agent, you know that I'm telling you, you need to double check the condition of the house.
But I understand all of that.
For sure.
And I'm not disputing
yeah.
that. What I'm trying to say is the seller's agent also failed
Yep.
their client.
Yeah.
Because they should know that would be a
Because
problem
if
with
you're talking
FHA.
about everybody trying to eat,
Yep.
It should be.
you know, what are you doing?
And they
What are
should
you doing as
know-
a realtor?
They know we're going FHA.
Yeah.
It's listed on the contract.
That's what I'm saying.
Yeah. So how? Yeah, they should.
Say
1,000%.
Right.
1,000%. Totally agree. There's multiple chances for that to be called out.
Yeah, I got
I
you.
mean, ultimately, man, when I hear scenarios like this,
Yeah,
call
somebody.
me a weirdo, but the buyer's agent, okay, yeah, it was stupid,
Yeah.
but you can always buy another house.
Mm-hmm.
But the seller's agent, once an appraisal is on record, you can't erase it.
Especially for
So
FHA.
if I'm selling a house,
Yeah.
and my listing agent let an FHA appraiser come through there, and I got a roof in the ceiling,
Right.
and now I can't sell my house, you fired.
Yeah.
So at the end of the day, the seller's agent is the biggest goof.
It is.
Yeah.
That's
Oh,
why I
That's a good
said
point. That's a good point.
You know what I'm saying? 'Cause
That's
you
what
can't
I'm
erase
saying.
it.
Correct.
You
Correct.
can't.
As a
Correct.
sales agent, I'm not gonna even let FHA, somebody's FHA even.
And that's what
That's
we're
what
doing.
I'm saying.
That's a good point.
It's a seller's agent right off.
Yeah, that's a great point. That's a great point. Yeah, definitely.
Yeah.
Not everyone doing their jobs.
No, but to your point though, that is muy importante.
Yeah.
There's a whole.
Yeah.
You gotta start rolling.
So yes, so if you see holes in the roof, let your loan officer know. Condos, huge issues. Okay, FHA. Most condos need to be approved with FHA to go FHA. 99% of the condos in the Houston area are just not. They just don't know how to do it, just too lazy, or just know they won't get approved. We do allow spot approval, so if you do bring me a condo that's not approved, we will help them get approved. Now, don't ask me for a 30-day closing. Because
Right.
now we're working with the FHA. You gotta
Right.
get them approved and working with an apartment complex for them to get stuff turned in. So we're looking at more 45 days for that. Common problem that we're seeing now, even with conventional, because condos will want to go conventional, right, to avoid the FHA approval. But we're seeing now is condos are starting to do pool policies, and that is not allowed under the guidelines. Okay, so basically grouping in all the units under one policy, which makes the policy much cheaper, and it's not allowed under the guidelines of Fannie Mae, Freddie Mac. So when you're searching for a condo, you have to go traditional financing. Ask for the HOA for the insurance policy up front. Send it to your lender.
Because that's
Just- and they'll let you know if it's a
the
no-go,
like
right?
doing that. That's what's it called? Some other kind of grouping.
The-
pool, yeah.
Yeah, they're just basically called a group policy or pool policy is what they're called.
Yeah.
So if you send it to your lender, they're going, why are you sending this to me? Maybe you want to use a different lender because that is a huge problem that right now that every lender is running into who does a lot of loans. We're getting these condos where the insurance policies are different. Some or not correct, excuse me. A lot of condos, if we sell them, hey, this is not compliant to Fannie Mae, Freddie Mac.
Right.
You're not allowing any buyer to come in and get financing. You are now stuck with cash buyers only. They'll go, oh, that's a problem for us. They'll go back and fix it. But some are like, too bad. We're not trying to spend that money. Can't close it. Non-warrantable condo at that point.
Let me know if this is too much like asking for the secret sauce.
Mhm.
But do you guys have a percentage requirement of how much the community fee can be in regards to what the monthly will be for condos?
You're talking about the HOA fee?
Right.
No.
Because what I'm saying is, if let's say you can have a condo for 125,
Mhm.
but the community fee is 450.
Right.
Do you on your side have a litmus test for this is outside of the constraints of what we feel like we're willing to invest in?
Basically.
Okay.
Basically, yeah, because we're gonna get their financials. Like with the HOA, we're gonna ask for the HOA docs.
Mhm.
And in those HOA docs, list the financials of the HOA. If the HOA is not in good financial shape, under the water and negative, that you can't approve that.
Right, because to your point, it's almost as if the values of these residencies are not growing as quickly as the HOAs are going up.
Right.
For all the reasons that you say, insurance is going up. They're
Oh,
trying
yeah.
to pool the people
Oh, yeah.
to get a lower rate, but even that lower rate is higher than what they want to pay.
Correct.
And the community fees are going up.
Correct.
Because as I look through them, they're going it up like $65, $70 a year, easy.
These HOA fees are ridiculous, man.
Yes.
They drive me nuts.
So
Nothing
on
drives me
the
up the wall.
lender side, right? That's what I was wondering. Do you guys have like hey, is it like 30%? Like
I can't tell you that I can't remember the number right off, but I'll send you the guidelines specifically on the HOA test because yes, we have to get the financials and they can't be under a lawsuit or under the water for because we've seen where we've gotten HOAs are like negative balance or they're just they're basically if there's a company you go bankrupt,
right.
No,
I'm definitely with you. So that's one of the reasons why sometimes I'm hesitant to do showings of condos before qualification.
Yep.
Because if somebody falls in love with the unit or the building,
yes,
there is no adequate trade-off.
Right.
And they're not gonna understand it. Well, the lender says that the community fee
They're like,
right. So from that standpoint, I would like for it to know that it's a go
right
before we see it.
Yeah. Yeah.
Yeah.
That's why it's important to, again, make sure you get the HOA docs up front because a lot of times we're getting that in the middle of the process or used to, and we need that up front now. Because again, we're college, we need it before contracts accepted, before contracts are even written up, right? We need to see those documents.
Too, because when you're qualifying them anyway, you'll be able to tell them whether or not they qualify because of that, right?
Correct. I mean, yeah, that's the main thing is making sure, the overall payment with the HOA is still coming in under what they're approved for. That's why we always want to be careful on condos and apartments. Look for condos / townhomes, right? You can still find these like row homes that I call them more row homes. They call them townhomes, not stacked up. They're just single family long ways. Something like the Memorial area that my in-laws are buying up. I love those homes, but those are townhomes.
Yeah.
We don't have problems with townhomes. If it's considered a condo, that's where we have to get the condo docs and get specific approval with FHA. If you go to the CAD online and it says TH under the description, townhouse, no problems. That's a single family home, no problems.
Does that have anything to do from a property standpoint with them having exterior fencing around the exterior of the community?
Like it'd be considered a townhouse?
Right.
No,
if it's open, like you know what I'm saying?
Correct.
Right.
But most of the times, if you see it like where it's open, not have to go up some stairs to it or
just drive.
Those are going to typically be actually considered townhomes.
Right.
Yes.
But if it's behind a gate or automatic gate, you have to do the code. Then
that's more than likely going to be a condo. Yes. All right, moving to VA again. I teach a whole class on VA loans, so we'd love to teach that as well. But VA loans for anybody who served or presently serving in the U.S. military must be an active vet or an active member. You can't have co-signers on a VA loan unless that person is also a vet. Okay, so the only person who can co-sign on your loan is the spouse. Okay, 0% down, of course. Rates usually match FHA. no mortgage insurance. You do have a funding fee wrapped up into the loan amount, kind of like FHA's mortgage insurance premium that's wrapped up into the loan amount. But if you're more than 10% disabled with the VA, you're exempt from this funding fee. Okay. And of course, if you're 100% disabled with the VA, no property taxes. Let's keep going down. Primary homes only. They don't do second homes. They don't do investment properties. You can have multiple VA loans at a time. That's the biggest thing that I hear. It's like, oh, I can't have two. You definitely can't have two. All right. Now, if you have like a $800,000 VA loan, you can't get another $800,000 VA loan. It's more like a 300K and another 300K. Okay. It's all about your entitlement. So if you have a buyer who's a VA and wants to get another VA loan, send the loan to me. A little quick calculation. It takes about 5-10 minutes to do the calculation. And we can tell them, depending on the current home that they have, here's the max purchase price you can go up to, still putting 0% down. Okay. So you can't have multiple. Typically can't have more than 3.
Please
Go ahead.
ask questions, because I was gonna ask you.
No, no,
Go ahead. Go ahead.
No, go ahead.
Go ahead. Go ahead. I want to hear it. I want to hear it.
No,
Okay,
yeah,
go ahead. No, I'm saying, because it's kind of foggy for me.
Mhm.
You can't do an investment,
Correct.
but you can have 2
I
VAs.
see what you're about to say.
So we're gonna say, we homesteading both,
No,
residential?
you can move out and you can then be considered an investment property. You just can't buy it as an investment property is what I'm saying. So you just like an FHA loan, you buy it as a VA loan, right? Primary home. A year later, you move out, you can rent it out. There's no problem with that. You go buy another primary home. You do have to take the homestead off the first home. You can't do
Right,
that.
you just gotta put
But
the homestead.
you can have two VA loans and one be considered an investment property after you've lived in it up to a year.
Gotcha.
Mm.
Now, with VAs, for whatever reason, I understand some of them are, maybe they're 100% discounted, but they have, like say a civilian job or what have you.
Mhm.
But then they get let off their civilian job, but they're still paying their rent and everything through, their VA, from their disabilities. But then, let's say they're now just, I don't know, going to school or something like that. How do you work with that scenario as far as getting them approved for a home now?
Like income.
Yeah.
So
Yeah, because you still got to validate their.
if they have disability, we can
Right.
use disability.
Okay.
They don't have to be employed to use that.
Right.
So as long as they're getting disability, that's no problem. Now, a lot of veterans or people actively duty, they're getting money for school. We can't use that.
Okay.
We can't use the money
Yeah.
for school because we know that's not going to continue for the
Right.
life, right? Now, again, if they leave their job and they're still getting VA disability or VA income, we could still use that. We just can't use the income from the job that they just left.
Yeah.
Mhm. All right. All right, no loan limit. All right, a lot of lenders will tell you, hey, there's a loan limit for VA. There's no loan limit. You can go up to $1 million home and still put 0% down. A lot of that is lender specific. We do not have loan limits for our VAs. Okay. Residual income, again, this is part of the second class or part of the VA class that I teach. But VA residual income is the income left over after expenses, the mortgage payments. So like childcare is definitely a huge major factor in residual income. So if we see somebody has kids, we have to ask, hey, what do you pay for childcare? Are they in school? They need to write a letter after hours care. So all of that is definitely important on VA. Moving to USDA, we're not going to touch on this too long because again, the chance of y'all doing a USDA. Have y'all done a USDA? If so, when's the last time? Unlikely. Conroe used to be the spot. I mean, now that's all development up there. So
Right.
USDA is gone.
Right.
So USDA is getting further and further and further away.
But
So
speaking on that, it's still like a desire of the public, right?
oh yeah.
I run across people that saying, "Oh, I would like to buy land."
Yes.
because I have an idea on building my own home.
Right.
How do we assist on that? How do we get them?
So land, that's going to be a little bit different of a process, but land is going to be typically 35% minimum down.
Mm.
There are some banks that you can find that are around 30 to 25, but most of them are going to be at a higher down payment amount. And then our minimum loan amount is 100,000. So with the minimum down payment, with the minimum loan amount, that's typically going to put our minimum purchase price around 140. We do offer construction loans. Okay, where you can roll in the purchase of the land loan into the construction loan, but I'll get with you separately on that because we can talk a bit more about that. But the USDA, that's for if a home is on it. All right. Now, again, no down payment for USDA. You can check the USDA website to see if the area is eligible and primary home only. Okay, down payment assistance. So 620 minimum credit score for our down payment assistance. Now we just got a new in-house program. It's a 0% down FHA program. Now the second lien covers that down payment, but it's a really great program. The debt to income ratio mirrors FHA, so 56% is the max there, and then the 2 to 5% of the loan amount can be given as assistance. The more funds that we take from the down payment assistance program, the higher the rate will be. And then again, it's a 3-year forgivable loan. I'm talking mainly about the T-Shack one. After 3 years, you can refinance. But it's a really great program, again, for someone who doesn't have the down payment, just has the funds for closing costs. Max income for the Houston area is about 126,000. So as long as we're under that, we can go on down payment assistance. If you're in a revitalized area, the max loan amount there is 130,000. Down payment assistance is not just for first-time buyers. It's what I hear a lot. Hey, I can't get it. I'm not a first-time buyer. You can be a second-time buyer, third-time buyer, 10th-time buyer, and still get down payment assistance. All right.
Well,
Go ahead.
with that part right there, I know it doesn't matter, but people always like to ask.
Yeah.
Like from when you buy your first home, how much time is it? 2, 3 years?
You can't own a home. I believe it's different rules for different programs.
Okay.
Some programs you can't own a home for 3 years. So if you sold a home, wait 3 years, you can be considered a first-time buyer. Programs are 5 years. You can't own a home for 5 years, then you're considered a first-time buyer again.
Gotcha.
For our first-time buyers, T-Shack again, great program, not just for first-time buyers. There are specific first-time home buyers with this program, but some other programs, Fannie Mae, Freddie Mac, they have a really good first-time home buyer program. It's 3% down. If you have below 80% area median income here in the Houston area, you're going to get some really good rates. If you are on the program, the 3% down, the rates pretty much mirror somebody who's putting 20% down. So someone's like, "Oh, am I going to get good rates putting 3% down?" Total myth. You're gonna get a pretty good rate at 3% down, being a first-time buyer. All right. So once under contract, this is when we really start to fly, right? This is we get you pre-qualified, balls in your court. Now you're going to go start looking at homes and really getting going. So we're going to get updated. It's like your pay stubs, your bank statements, get a loan estimate sent out. Once the LE is signed, the loan estimate is signed. That's when we'll move the file to a processor, which is again my processor, Chastity. She's amazing. Once the home inspection is done and y'all tell me, hey, all cleared, that's when we'll get the appraisal ordered as well. That's a good time to go ahead and get the insurance ordered. While all of that's happening, we're getting the buyer thrown into underwriting for that approval. Once the loan is approved with underwriting, we'll get any extra documents that the underwriter is requesting. Pretty easy there. A lot of times, again, we're looking to get the documents up front. So when we go to underwriting, there's not a lot of conditions that we need. After that, it's a smooth, easy ride to the closing table. Once the appraisal is in, we'll get the initial closing disclosure sent out. And then once the buyer has turned in any extra documents that we need, we'll submit for a clear to close, and then you'll get those 3 happy texts or 3 happy words from me, clear to close. Final CD will be sent and see you at the closing table. I like to make my closings when I can. I can't make them all the time, but if I can, I like to be at my closings because y'all get to meet the clients. Y'all get to have fun with the clients. I get just to be behind the computer doing the typing and everything. So when I get the chance to go meet the client, bring a closing gift, I like to do that when I can. Okay, so usually I like to go through a loan estimate, but we're gonna skip this part. And I'm gonna go through some non-QM programs that we got going on, and then we'll get finished up here. All right, so non-QM. So again, non-QM, non-qualified mortgages. This is for anybody who can't go the traditional financing route. Self-employed people, right? So self-employed people, when you go file your taxes, you're writing off your deductions, writing off your expenses to where you're not showing as much income maybe that you truly make, but the goal is to pay less in taxes. Totally understand. But when it comes to getting a mortgage, it can bite you in the butt a little bit. So a bank statement program. So I would say I love the puzzle loans. I love the hard loans, the easy ones. I don't get me wrong. I'll take the easy ones. Give me the easy ones. But if you have a hard loan, I want the hard loan. Okay, that's where I get to sharpen my tools. That's where I get to really become an expert at these programs. And I've done a lot of these programs. I'm closing a $1.8 million. We just got it cleared to close today on a profit and loss statement loan. So a lot of great loan products out there. All of these programs come with a higher rate and a higher down payment. Okay, so you're not going to be able to put your 5% down, and you're not going to get a 6% rate unless you buy down. But like a bank statement program, we're looking at the deposits on the last 12 months of bank statements. We're going to make an average deposit on those or an average income on those, and that's going to be your income. So let's just say your last 12 months of business bank statements show $10,000 of average deposits. We can use a 50% expense, or we have to use we have to use a 50% expense ratio unless a letter from the CPA provided to say, hey, their expense ratio is less, so we can use more income. So again, if the average deposit is $10,000, 50% expense ratio would be $5K monthly. All right. If we get a CPA letter saying their expense ratio is 10%, then we can move that income up. For example, I closed a client, this was a couple months ago. Looking at his taxes, I was only able to get about $2K of monthly income because of everything that he written off. Using his bank statements, I was able to get $37,000. I'm not bullshitting you. $37,000 of monthly income. He can buy whatever the house he wants at that point, right? Easy loan to send through. That's a closable loan gone. Okay, so these bank statement programs are awesome for our self-employed. Again, mainly for our self-employed people. So if you have a credit score over 700, you can still put 15% down. Rates on those aren't pretty, so I still recommend putting 20% down on this product. This is an example. So is this the example for my client? This is a different one, actually. So client gross receipts showed $124,000 on yearly income. Pretty good. After their expenses, they're showing their net profit of $53,000. Not terrible, but for the home that they were wanting to buy, we're not able to get that. Using the bank statement program, the monthly qualifying income that we can use, $53,000. We went from $53,000 of annual income to $53,000 of monthly income. Again, you can buy whatever you want at that point, right? Go buy the home that you want. So that was a closable loan, but this is an example of why we would use a bank statement program. Because again, writing off too much, and then again, when it comes to bank statements, looks all good. I-10, so this is for anybody who does not have a social security number. They have an I-10 number. We can still do loans for them. Typically going to be on a bank statement program because most of these people are self-employed. A DSCR, this is for our investors only. You cannot be a first-time home buyer. Typically, you have to have a primary residence to do this program, but this is a no income, no employment loan. So if somebody is not employed, but an investor, maybe they just rent out homes, this is a program for them. Okay. The way we qualify these people is off the market rent and the proposed principal and interest. As long as the market rent and the principal and interest, taxes and insurance, the total mortgage payment are the exact same, or the market rent is more, that's a closable loan, easy, done. All right. Basically, I depend on my realtors for this one because you need to tell me what that market rent is before, so I can tell you where we need to keep the actual mortgage payment, which will then tell us where we need to keep our down payment at. But this is a great program for our investors who just want to get a little savvy and again, maybe write off too much on their taxes. The last two I wanted to go over, asset loans. So this is for anybody who is typically retired or just has a ton of money in the bank. Same thing, got a client on paper, not showing a lot of money, but when we go look at the retirement account, they had about $40 million in their account. I hope my accounts look like that one day. But it was just, oh my gosh, you got a ton of money in there. We can't use money because of your taxes. We can't use income because of your taxes. But all I need to do is take your assets divided by 84. That's a closable loan. Very, very, very easy. Again, higher rate, higher down payment. The last thing I'll talk about is the profit and loss. That's a loan I'm doing right now. These programs are great for realtors. So anybody who is self-employed, works with a great CPA. This is where I will work with the CPA to get the most recent 12 months of profit and loss. Whatever income is listed on that profit and loss statement, divide that by 12. We can use that income as long as the bank statements support that income. That's the main thing. Because the CPA can BS a P&L statement, but as long as the bank statements support it, then that's a closable loan. And these are today's rates. So 6.75 is the average for a conventional loan. 6.33 average for an FHA loan. So still mainly in the sixes for rates. We hope to get out of them, but if you're asking me my forecast, hey, where are we going to be the next 6 months, 7 months for the year? I would say we'll probably be about the same where we're at right now. I do not expect the fives to come down come anytime soon. I expect us to stay in the sixes for probably another year or so. Just to kind of show y'all where we've been. So I do this, I teach this class a lot. Every time I teach this class, I like to show where I had the rates before. So I copy and paste. So today we're at 6.75. Before this, we were at 6.85. Before this, we're at 6.95, 6.38. So we had jumped down. Before that, 6.58, 7.11, 6.8, 6.88, 7.72. So you can see how up and down we are throughout the past 2 years. Just because we went down to 6.32, that was a great day. My phone was ringing off the hook I think it was last October. My phone was ringing because rates were starting to shoot down. I was getting people in the fives, and then they went right back above 7%. So just because rates fall does not mean we're not going to go right back up. Okay.
And it doesn't mean that it ain't gonna keep going.
Yeah, for sure. So I
You
do
gotta get in where you fit in.
Yeah, exactly. You buy when it's comfortable for you. Don't worry about the rate. Rates suck.
You know
Well,
what I'm
if
saying?
you can afford that payment, if you're going, hey, that's a comfortable payment to me, why are you not buying right now? Especially in the Houston area. Missing out. Um, Last thing to finish up here, again, don't stress. LO's job is to make it smooth and easy. We close loans in about average of 20 to 30 days, of course. Bigger banks typically take about 45 to 60. I will give them a little bit of props. I have seen banks start to do a little quicker jobs on closing, so I'll give them props there, but we can definitely close much quicker than a bank. Get pre-qualified 3 to 6 months out. Always recommend the earlier the better, just so we have some things to work on, or if there are some things to work on, I can lay that out for the client. To me, it's never a no, you can't buy, or it's, hey, no, you can't buy right now. It's a not right now. Okay, maybe it's a year from now, maybe it's 2 years from now, but I'm going to lay that out for them. Hey, today's not the day for you, but here's what you need to do to get there. Okay, so with all my clients, even the 500, 400 credit scores, to me, those are my best clients, right? Because when we get them there, they're loyal and they refer my name out. The last thing to finish up here, if you don't have my contact information, make sure to scan that right then and there. It's going to bring you to my website or one of my websites. And you can save my contact from that. And then when you click on my name, save contact, just make sure to do create new contact in your phone, or I won't be in your phone.
Right.
And then when it asks for your information, just share your information so I can have it as well. But again, I'm the all-around loan officer, weekends, after hours, late nights. If you need a loan officer to answer your call, get your client pre-approved. I'm that guy to answer your calls and questions, your clients as well. Want to make sure we're getting to them in a timely manner. Pre-approvals takes me about a business day to get through that. So we're super, super quick on my side. And again, just looking to build. So anytime you have any questions, if you have a listing where you're going through a bunch of offers and you're going through a bunch of pre-qual letters and you want me to reach out to the lender for that buyer that you're vetting, I would love to do that. I do that for a lot of my realtors, just to provide some consultation, just again, so I can provide some service back to y'all. If y'all don't have any questions, like I said, reach out to me. Next pre-qual buyer that you got, all I ask is try me out in the next one, and you'll never want to use anybody else after that. Any questions or anything? All good to go? Awesome, y'all.
Shay said she has a question.
Yes.
So as far as your asset loans go,
Yeah.
is there like a certain amount of assets they have to have or?
So no. So whatever assets that we have, we divide it by 84, and that tells us what their income is, and then that will tell us what type of home that they can afford to buy.
So can they also have income as well?
Yeah, we can do a hybrid.
Interesting.
Yeah, we can. We can do a hybrid loan.
Okay, and then I lost my last question.
I got a question for you that might help. How do you go about helping clients? I mean, I know this is like the magic wand, right?
Yeah.
But let's say you get into a scenario, you're going through a process with a lender, and for whatever reason things fall out. How do you save a deal?
Man.
And then on top of that, how do you save an escrow?
How you like save an escrow, like your earnest money is what
Yeah,
you're talking
that's
about?
what-
Couple different
I'm sorry, I
ways.
said escrow.
No, you're good. You're good. So saving a loan, that's never really a huge problem for me because the reason for me it's not is because I do all the work up front. Now I'm saving loans a lot.
Right,
I get
like
calls
another like
all the time. We're all getting
agent
calls.
says, "Hey, I got a situation."
Lender
here."
can't close it for whatever
Right.
reason. This profit and loss loan, it's a $1.8 million sales price. We're under contract with a different lender. Lender's like, oops, sorry, we can't close it all of a sudden. I get the call, should have done with me first, but I get the call, like, yeah, we got to go profit loss. We can't go conventional. I don't know why they even said you can go conventional in the first place. So it's knowing guidelines, it's knowing the programs, and knowing the guidelines in those programs because the guidelines and profit loss bank statements, all of them are different. They all have
Yeah,
different. Some allow first time buyers, some don't. Some allow reserve, or some need reserve, some don't. So knowing that is how I save deals on a monthly basis. I save at least minimum one a month, dude.
Gotcha.
It's
I wish they did
crazy.
this a week.
Yeah, it's crazy the calls that I get. Like, hey, this lender can't close it, and I'm looking at it. It's like, why?
Right.
Why?
Right.
I'll take it, sure. Give it to me. I'll take that any day. But all the time, recently, actually got a Save Me loan yesterday. Builder was like, hey, you can't go FHA. Why can't they go FHA? They have a FHA loan now. They're selling the house. It's under contract. It's going to be sold the day before we buy this home. Why can't we go FHA? Fine, get away from them. They don't know what they're talking about. Send it over to me. Easy. So yeah, knowing your guidelines, knowing your programs is how I save deals.
Got it.
And then the escrow part, that's just being protected on contract.
Right.
If you're past the 21 financing days and the appraisal and the lender's going the day before closing going, sorry, no one can save that money.
Right.
That money's gone.
It's gone. Right?
Yeah, and that loan officer will probably be gone at some point too. Yeah.
Right.
No one's gonna use that person.
Right.
Again, our name in this business, and same for y'all.
Yes,
It
same.
means so much. I mess up a deal for you. You're gonna go to him. You're gonna go to her. Hey, that man Mason, don't
Sure.
work with him.
Yeah.
He just lost my commission check.
Don't
Don't mess with no one's money. Don't mess with no one's money. But yeah,
All right, thank you all for joining today. Mason, that was wonderful. We appreciate you coming out for us. So without further ado, you guys are free to go. Thank you for joining. Bye-bye.